Thanks, Mark, and thanks everyone for joining us today for these presentations. Look, emerging markets, when most people hear about it, they think of the headlines like China is uninvestable, or Turkey's got hyperinflation, or a good place to go on a holiday, right? So the things I want to go through today to talk about our fund and how we invest is just looking at the emerging markets, where they are from a policy and a cycle setting. Then go through a couple of the structural opportunities. As a teaser, I'll talk about a stock or a bank that has the same return on equity as Commonwealth Bank, has 2.5 times the growth rate, but is trading at half the valuation multiple. Then I'll go through the portfolio positioning and why Antipodes for emerging markets. So straight into the cycle. If you thought of we'd go through a global pandemic, we'd have a war in Europe again for the first time in many decades, you would not think that many of the EM countries would go through with the macro cycle the way they have. So to run through a few, like Latin America, who's got a lot of experience in dealing with inflation, has been able to knock it on its head very quickly. And just a couple of numbers, like Brazil has printed a CPI of 3% last month. Australia last print was still in the 5s. Their interest rates went from 2 to 14%. So we're still sitting at 14% interest rates there. A very tight monetary policy, but the inflation issue has in many ways been addressed. India, Indonesia, Mexico see these as good structural growth markets in emerging markets. They've got great demographics, great government, very business friendly. But they too have actually shown quite a strong fiscal position, and their current account has remained very steady. So if you look at the Mexican peso, it's one of the strongest currencies in the world through the COVID period. China is the one that I'm sure everyone has read a lot about, that the recovery has stalled. And for us, that's because property is in an L-shaped type of recovery, which means it's not bouncing back very quickly. You used to build 16 million homes in a year, which is far above the whole housing stock in Australia. That was down to 9 million starts last year, and we think the right number is about 10 to 11. So that's been a big drag on the growth, and you're not going to get that bouncing back. Employment will take time to recover as it's SME-led. But when you look at the policy setting, it's very, very attractive. CPI is 0 in China. And there are many industries that the government is targeting to grow in the renewable space, for example, or other areas. So that economy, I think, has a slower recovery, but there's a lot of factors that could see that bounce coming through, and especially in targeted industries. So we think as rates in the US start to peak, capital flows will return to emerging markets, and given this starting macro and policy setting, it could be quite a strong rebound there. And valuations at Antipodes, core to our process, is looking at what you're paying for something, ensuring there's a margin of safety. And we think with China trading at the lowest relative PE, cyclically adjusted PE in 20 years, it more than factors these structural issues and the geopolitical issues in the country. And you can see other EMs there, barring India, which I'll come back to, are very cheap relative to the past. So really the message on cycle is we're in a better macro and policy setting in EM than in many developed markets, and the valuation setting is much more attractive. So this chart here, it gives you some of the higher level structural opportunities available to many EMs, and you might tell me that China's demographics are pretty poor, and that's true, but selectively they're exposed to many other structural opportunities, such as renewable energies, for example, where I've got CATL as an example. But I'll go through a couple of these in more detail, and the first one being consumer premiumisation, modernisation. By definition, an emerging market will see its population get wealthier, which means your spending goes from necessities, food, to more luxurious items and discretionary items such as travel, fashion, e-commerce is an enabler of that. But the example I'll take you through is Mexican air travel. So in Mexico, there are 60 million trips taken per year, which is 0.5 per capita. In Australia, we're all high flyers and we travel 3 times per capita here. It's a big jump in terms of penetration, but to put more numbers around that, 60 million air trips, there are 3 billion bus trips in the country, and of that, 800 million are what we would classify as could be transferred to air, where they're over 6 hours, and in fact, the price of that bus ticket is higher than if you had bought an air ticket 2 months earlier. The airline industry is consolidated. There's 3 players, and we own Volaris, which is the largest with 45% market share. They're an ultra low cost carrier. Cost per passenger is the second lowest in the world, just behind Ryanair. And the return on equity in this business is in the mid 30% range. It's trading at about a 20 to 30% discount to Ryanair and over half the valuation multiple of Interglobe, which is a very similar airline in India. So this is an example of a company exposed to long industry growth in a country of Mexico. It's got a big macro growth that is trading at a very reasonable valuation. The other area that all of EM, I would say, is exposed to is credit and finance penetration. Similar to buying luxury items, you typically will start to get a bank account and credit as you get wealthier. And there's no better chart to show that opportunity than this one, I think. In the Philippines, 2/3 of people don't have a bank account. And in Indonesia, that is 1/2 of people don't have a bank account. So, getting a bank account's the first point. That doesn't really give a bank much earnings. But as they go on from a bank account, they then borrow, etc. So the company that I was teasing with earlier regarding the comparison with CBA is Bank Mandiri, which is one of the leading banks in Indonesia. That's a consolidated banking market of circa 55% in the top 4 players. Mandiri generates best-in-class return on equity of 20%, similar to CBA, but its growth is in the low teens. And like I said, with half the people not even having a bank account, they should be able to grow at this level for a very long time without having to worry about how expensive property prices are, like you do here. And the valuation's trading on 1.7 times book, 10 times PE, half of where CBA trades. Now I'm using CBA here as a bit of a relatable example. What we benchmark it to in our universe is HDFC Bank in India, which has similar growth, slightly lower returns, but that is also trading at 2 times the valuation of Bank Mandiri. So this is one of the core holdings in the emerging markets fund and in our global funds for that matter. So I hope these 2 examples, what I'm trying to show is EM is not about going and buying random businesses that are exposed to high growth in a developing economy. It's about finding really good quality businesses that are in industries that are modernised, have got good governance, good management, and really are operating very similarly to the way that what you would find in a developed market. And you've got a much longer and much faster growth profile in the underlying business. So that's the way we try to, I guess, dedicate our research and then construct a portfolio for the Emerging Markets Fund. So this here, just some examples, it's not the whole portfolio, but some of the logos of our key holdings, and it's shown in the way we think about risk, which is cluster exposures. So by clustering our stocks within similar exposures, that allows us to be aware of our risk and manage the size of that risk, but also to you look at our research within each of these clusters and then identify where we see a greater opportunity to then look for other ideas. So an example is energy transition. Renewable energy is a category that most emerging markets are very well exposed to. And that's been a very strategic decision by countries like China that have led in the technologies in that area. So we'd start with that initial work on, let's say, electric vehicles. That led us to buy CATL, which is a key holding, which is the largest battery maker in the world, the most efficient battery maker in the world, that companies like Ford are willing to partner with, despite the government really trying to push them away from Chinese corporates. And we'd start with that, and that led us to work in lithium, and we own SQM, which is one of the biggest lithium producers in the world, based out of Chile. So it's just an example of how we look at risk and opportunity within our portfolio. This is a summary of our regional exposure. So I've sort of talked about China, where we think the current valuations are bringing up an opportunity to buy key structural growth companies at very attractive valuations. So again, I'm not talking about a big macro tilt to China. It's an opportunity to buy selective opportunities that have structural tailwinds. Indonesia and Mexico are the key overweight markets, and that comes at the expense of India. India is another market we really like. I just spent 2 weeks there a few months ago, so we're looking for ideas there. But we're finding companies to invest in with a far greater margin of safety, with similar growth opportunities in Indonesia and Mexico. So they're key markets that we like. And then Brazil, again, is another cyclical opportunity, where I said you've got 14% interest rates, inflation has been dealt with, you've got some very good listed companies, and if we do get a normalisation in policy in that country, that'll be a big tailwind for a lot of the earnings in these businesses. So to wrap it up, why Antipodes for emerging markets? So I lead the emerging markets team within the business. That's a team of 5, but we sit within a team of 35 in the investment team. And that is very powerful. I can't overstate the importance of this. We get research from our global teams, let's call it research on global auto sales, that we can then feed into our models for CATL as an example. We've got a global commodities team, macro and quant. That is a very important part of our process and allows us to select the best ideas within the emerging world. We've been looking at emerging markets from the very beginning. I've put there as a stat that over 50% of the cumulative alpha in the global funds has been driven by emerging markets exposures. And lastly, just our style is what we call pragmatic value. Very simply put, we care about valuation. We have a value tilt, but we don't look for companies with a low PE. We look for companies that we think are cheap relative to the opportunity, the growth, and the returns that business can generate. And we think that's important everywhere, but especially in emerging markets, where you need to look at that long runway of growth to really understand what a business is worth. So I know that was quick, but I hope you guys learned something about EM and how we look at it at Antipodes. So thanks for listening.